Name is Anthony Bolduc, and today I'm going to be providing a Florida insurance update for HH Insurance as it pertains to flood insurance across the state. So let's go right into it. So, going to be talking about the National Flood Insurance Program a lot today, the NFIP. This is the FEMA funded, government backed option for flood insurance that provides a rate for just about every flood policy except for CBRA flood zones. It's seen some major changes in the last 10 to 15 years, and because of that, we've had some serious updates to which policies are going to be more effective, more cost effective, the NFIP policies or the private market flood policies. So we're going to discuss those changes today and give you some context for exactly what's going on with both types of policies. So what is happening with flood insurance? Flood insurance is a federally regulated industry, which means that state legislation does not affect it. The NFIP, like I said, is the FEMA-funded government-backed option for flood insurance. We're going to talk about how they had a flood map change and a rating change recently and what that has done to the rates. We'll also talk about private flood marketplace options. And then at the end, I'll show some rate examples to show you exactly what our customers are dealing with across the state. So, how did we get here with the NFIP? The NFIP was initially put in place in the 1970s to provide flood insurance rates for homeowners across the country. In Florida, we had a gradual increase of population year over year from the 70s even until now. But this graph shows from 1978 to 2012, gradual increase in the amount of people moving to the coast in Florida. Each one of these people was in a flood zone. They had to have flood insurance, and therefore, naturally, the total premium of flood insurance went up year over year. Now, that is not an issue with the policy program. What is an issue is the lost dollars paid and how that affected everything. So, in 2005, we had our first major loss. We did have some before, like 2004, you can see is higher than the rest, but everything before that was below this first line. And then in 2005, you can see it shoots way up, way up. And this is what caused an issue. We've had some serious losses in the last 10 to 15 to 20 years, and each one of these losses has caused changes in the system. So as you can see, Hurricane Katrina, August of 2005, 16.2 billion. That's the worst loss we've had in the last 20 years. Actually, it's probably the worst loss we've ever had. Hurricane Ike was at $2.6 billion. Hurricane Irene in 2011 was $1.1 billion, and then Superstorm Sandy, October of 2012, a $7.1 billion amount payout. You can see that each one of these events, along with all of the lesser events in between, caused major payouts, which is why the NFIP program started to have issues with rates. So what happened? Well, in 2012, after Superstorm Sandy, actually before Superstorm Sandy, the government decided that they needed to act, and they passed the Biggert Waters Act. So the Biggert Waters Act went into effect July 6th of 2012, and it went completely under the radar at first. It imposed minimum deductibles, established a technical mapping of flood zones, and phased out most subsidies. Then, on 10/1 of 2013, that's when the act actually went into effect, and you can see that slab-on-grade homes have rates skyrocket to $10,000+ per year, alarming a lot of people in the state. At this time, private market flood programs emerged as an affordable alternative, which is why they became prevalent in the state. And this act also removed grandfathering in the transfer of flood policies, which is significant because this allowed people to maintain their flood rates if their home was still built up to code. And it also allowed buyers to transfer sellers' flood policies so that they could maintain lower rates and not have to write a new policy when they bought the home. Now, these changes were made immediately, which caused pushback and paved the way for the 2014 legislation, which was the Homeowner Flood Insurance Affordability Act 2014. Signed into law on March 21st of that year, it repealed certain parts of the Biggert Waters Act, including restoring grandfathering, putting limits on certain rate increases, and updating the approach to ensuring fiscal soundness of the fund by applying an annual surcharge to all policyholders. And from a technical perspective, we are still operating under the HFIAA of 2014 in terms of flood insurance regulation. It is the most recent act passed in this specific forum. So this brings us to Flood Risk Rating 2.0, which was the first methodology change of flood insurance rating since 1975 for the NFIP. And that's a big deal. So it's got a lot of compensating to do, a lot of catching up. Because of that, prior to this, flood insurance was rated on the flood zone and elevation of a home. So before this flood risk rating of 2.0, if you had a home that was in an AE flood zone with 2 feet of elevation, it would have the same associated premium regardless of the county. And obviously that does not make sense. Some coastal areas have much more risk than others, so flood risk 2.0 was necessary to amend this thought process and get it to be more accurate. With flood risk rating 2.0, the distance to tidal water, the elevation of your home, the value of your home, and other relevant details were used to rate flood insurance instead. This created a much more specific and tailored approach to each property, but it wasn't fully explained at first. They also removed grandfathering unless a prior NFIP policy was in place for the property. So that was a big deal. But it's allowed grandfathering, which was nice. It just only kept it to NFIP policies. So it is still a possibility for you to transfer a policy of an NFIP, seller to a buyer. But if it is not an NFIP policy, it is not possible. Risk rating 2.0 also complies with the existing statutory caps on premium increases at 18 to 25% per year. And when this occurred, we saw massive rate increases for Tampa Bay homes. The rate increases are the most substantial for lower elevation homes, coastal homes, and high value homes. So this was a big deal, and flood risk rating 2.0 was supposed to stop annual increases eventually once the full risk rate was realized, with an 18% cap being a caveat. And this led to FEMA making the claim that 96% of current policyholders' premiums will either decrease or increase by less than $20 a month under risk rating 2.0. What they failed to mention was this $20 per month was after the 18% cap was added on. So obviously 18% can be a lot when you've got thousands of dollars in a flood insurance policy. And so this was kind of setting the incorrect expectation for policyholders across the state, which is why so many people were alarmed when things started to go differently for flood risk rating 2.0. So let's talk about some of the most affected counties in Florida so you have some context. Here is the county level data, the highest percentage increases after flood risk 2.0 was put into place. So you can see Collier, Brevard, Indian River County, Flagler, Franklin, Lee, Martin, Monroe, and Charlotte. These are your main counties that are affected percentage-wise. And you can see the average flood policy for Collier County, for example, was at $1,000.53, and now it's close to $4,000. So you're looking at a 277% rate increase. Sorry about that. And you can see across the board for all of these counties, it's at least 150% rate increase. And this was something that occurred pretty much immediately for these homeowners. And so they've got to be sitting there scratching their head, wondering why is it that the change was so much. These absolutely massive rate increases caused it to be closer to $200 per month of a change as opposed to $20. So for those expectations, these homeowners were not seeing that kind of expectation met. And so you can imagine that a lot of these people are going to be very upset when they got their renewal bills for flood insurance. Now, per zip code, the highest percentage increases are a little bit different. You've got Cocoa Beach, Merritt Island, Indian Harbor Beach, Hutchinson Island South, Stuart, Florida, Melbourne Beach, Terra Verde, St. Petersburg, and then Naples. Those are going to be your main zip codes that are affected. And you can see the 1.0 rate on the left. I mean, a lot of them are under 1,000 or right around 1,000. And then the 2.0 rate on the right, the lowest one is $4,036. But the percentages are insane, between 409% increase and 761% increase. So these people, basically overnight, if not, when they had the renewal policy come through, all of a sudden they're looking at a renewal rate that's much, between 4 and 7 times as expensive as they were paying the year previous. And so that's going to be alarming for those people. So here are the most expensive zip codes, and they don't exactly match with those that were affected because some of these were expensive before, but you can see certain zip codes have 2.0 rates that are absolutely insane, from a perspective of how much you'd have to pay each year to have flood insurance. So in Naples, the average 2.0 rate, $8,000, just over $8,000. And even on the lower end of this list, you've got Captiva, Goodland, Marco Island, and Cocoa Beach, which are at $6,900, $6,700, and $6,600. respectively. Each one of these areas, if you have a coastal home, then you must carry flood insurance. This is the average rate you're looking at for flood insurance. So yes, I'm sure there's plenty of nice homes in these areas, but there's also plenty of homeowners that are alarmed by their rates and wishing they did not have to pay such, absurd premiums per year for flood insurance. All right, so now that we've gone through each of these zip codes that has the most expensive flood insurance or those that have been most affected, let's go through a few rate examples to provide context from our client's perspective of what they're seeing on the rates of flood insurance and how flood risk rating 2.0 has affected people across the state. So our first rate example is a nice frame built home here in Pensacola Beach, Florida. It is a coastal home, it is a high value home, and it is also a low elevation home. So we can expect that flood risk rating 2.0 is going to hit this one pretty hard, and that the rating has gone, or the premium has gone up significantly between the two changes. And here we can see that when risk rating 1.0 was in effect, they were paying $425 a year for flood insurance. And then when they re-rated it at 2.0, it's now $5,665. So obviously that is a big jump, but the risk here is high for flood insurance. And so this is why risk rating 2.0 affected this home as much as it did. And if we check the next rate example, maybe we'll have some comparison for that. So right, example 2, this is a low elevation home, but it is not coastal, and it is in the middle of the state. And this home is also a masonry built home, and it's in Dade City, Florida. So we can expect risk rating 2.0 did not affect this home as much. And let's see what the rates look like. So risk rating 1.0, it was at $3,663. It did go up by about $1,000 for risk rating 2.0, but it was not percentage-wise as affected as the previous home because it was not coastal and it wasn't quite as high value. When we look at this rate example 3, here we've got a very nice built home. It is high value, it is coastal, and it is a 3-story home there on a barrier island. So we can expect to see that the rates did increase significantly when risk rating 2.0 was implemented. And when we check these rates, we can see that at first they were paying $636 a year for their flood insurance premium, and now it is about $11,000 more expensive at $11,628. This is a perfect example of how risk rating 2.0 reshuffled the risk in Florida and reassigned the amount of premiums based off of who is really at the highest risk and who has the most to lose. So this home, it's a high value home, it's coastal, and so therefore it's going to be highly affected by that risk rating 2.0 change, and you can see that in the premiums. For rate example 4, here we've got a home that's not quite as coastal, but it's still a very nice home. It's high value, and it may be in low elevation given that it's in the Cape Coral area where there's lots of canals and inland water. And so we can expect that this home did see a rate increase, but it shouldn't be as significant as the previous example because it's not right on the coast. And when we look at their rates, so yes, they did have quite a big or substantial rate increase of about $6,000. However, it is not as high as the previous example because 1, it is not on the coast, and 2, it is not as high value of a home as the one previous. So it did have quite a significant increase of about $5,500, but it wasn't the $11,000 increase that the last home experienced. And you can see there the total dwelling value at $700,000. The last one was $1.5 million. So that's where the difference really is going to be those dwelling value differences, as well as one being so close to the coast and the other one a little bit more inland. For rate example 5 here, we've got a nice high value home. However, it is not coastal, and it is going to be in a bit of a higher elevation area. It is close to a lake, so pretty low elevation for the surrounding area, but not as low elevation as if it was directly on the coast. And so when we check risk rating 1.0 versus 2.0, you can see that the rate really didn't increase that much because it's not coastal, and therefore flood risk is not going to be nearly as high as one that's on a barrier island in St. Petersburg, for example. But this home did see somewhat of an increase, and that has to do mainly with that total dwelling value being at $1.25 million. See, the value of the home, the coastal location, and then also the elevation all play a factor. And so even though this home's not on the coast and risk doesn't really need to be reassigned here, the premium did go up because of the valuation of the home. And finally, rate example 6, we've got an inland home. It's in Claremont, Florida. It is close to a lake, so it's still in a flood zone, but it's not as high value as some of the previous examples. So we can expect that risk rating 2.0 did not affect this home as much, or maybe even went down in the premium. And when we check, that is exactly what happened. So risk rating 1.0, they were paying $1,969 for flood insurance. When NFIP risk rating 2.0 was implemented, that rate dropped down to $578. And this example is one that shows in principle that NFIP risk rating 2.0 did cause premiums to skyrocket for coastal areas and high value homes, but it also did reassign the risk and make sure that the premiums that those people are paying who are not in high risk areas is comparable to what they should be paying for premiums for flood insurance. So this home, like I said, it's inland. It is close to a lake, but it's not as high value and it's not as coastal. In fact, it's not coastal at all. And so therefore you can see that their premium did drop, which is one of the examples here that actually shows that. So I hope you can understand through these rate examples and through all that explanation exactly what's going on with flood insurance. Big changes have been happening, and I'm sure more changes are on the horizon. You can be sure that HH Insurance will continue to provide these updates going forward. And if you have any questions, feel free to give our office a call. We'd be happy to talk you through any kind of questions or discussions you might want to have. Thank you. Have a great, happy holidays, and we wish you guys a happy new year. Speak to you soon. Bye.